Hello and welcome back to Money Discourse. It seems like there's never a dull week going on in the markets. The central bank and the Fed especially seem to be using game theory with our economy. Just when we thought there was a semblance of hope, they came back, Powell with his iron fist, and has kind of wrecked things for us, hasn't he, Raj?
Yeah, I mean, everyone agrees that we had too long easy monetary policy, which obviously fueled the stock market. Now, and it was blatantly a mistake by the Fed and all the banks around the world to keep monetary policy as easy as it was, despite an overheating economy. But yet they did it because they're like transitory inflation, and now they got it wrong. They're backpedaling, and what they're trying to do is front load the rate hikes as much as they can to try to stem this flow of inflation. But that, now even I think that they're just going too fast, too quickly, and it's really derailing stuff. They're not given a chance for these rate hikes to do their work. So what they're doing, they're going just every month 75. We had Bank of England this week do 50 basis points, but we had 5 vote for 50, 3 vote for 75, and 1 vote for 25. But now the market is forecasting an almost like a really good chance of a 1% rate hike out of the UK. So the thing is, all of this rate hikes from the ECB, the Fed, and that is really derailing this market. And on top of all of that, this week we had the mini budget from Liz Truss's government, and as the first piece of action by the new Conservative government and a new leadership, where they pretty much enacted the biggest tax cut since 1972. So make that 50 years, the biggest tax cut in terms of their top rate of tax, the basic tax, the national insurance, pretty much all across the board. The corporation tax, they've reversed the plan raise. So the thing is that it's a big gamble there by the UK. But what was really interesting is, so let me just show you here, we can share the screen. It's the GILT remit, right? So where was it? So the thing is that this headline over here, so the Bank of England, the Debt Management Office, the net financing requirement for the next year is 234 billion versus the forecast of 162 billion in April. So so the UK is basically going to have 50% more worth of borrowing in this next year, which has spooked the markets. And now if we look at what the yields are on these bonds, so we look at the 5-year, 4.06%. And if we actually look along the curve for the UK, so the 2-year gilt is at 3.9, 3-year is at 4%. So it's pretty flat across the curve. But you can see that now we've got 4% rates across the board from 2 years all the way out to 30 years. But bear in mind, if you look 1 year ago, the 2-year gilt was trading at 0.39%. And the 5-year gilt was trading at 0.6%. So you can see how much rates have risen literally within the last year, and it's crazy. So we're going to have all of this funding by the government. So you can see across the curve, you've got the 1-year gilt, which is at 3.5%, all the way out to the 30-year, which is 4%. So it's a very flat yield curve, and you're going to have all this borrowing by the the UK government, 80 billion more than previously planned at these much, much higher rates. The market ain't liking it, and that's what led to a huge rise in yields and the stock market having another sell-off this week. And there's back-to-back 5% decline. So what say you? Would you rather invest in the stock market where it is, or get your 2-year yield at 4%? What would you rather do? And then I feel like there's this huge reallocation of portfolios with these massively high yields. If you're if you're like someone about to retire, would you rather put it in fixed at 4%, or try to, navigate what could be a very volatile time in the stock market? So it's this is what we're facing right now. There's the explosion in yields.
Yeah, definitely. This is very, very it would be very, very hard to turn down some of the really attractive yields you can get in some of these bonds. And if you even look at certain corporate bonds, it's even more lucrative. So, but then you can just look at what Goldman Sachs, were saying, potentially in a bear case scenario, mid 2023, we could see the S&P go down to 3150. They're forecasting growth for this year to be 0% and negative 1.1% in 2023 GDP. And the thing now we have to think about as equity holders is, in a recession, the S&P historically has fallen around, 30% or something like that. And if that's the case, we have to ascertain whether we're already in a recession, or are we actually just going to start that 30% fall now? And where can you hedge? Because it seems like there's not many places you can kind of put your money apart from cash. Again, if inflation
long
is
US dollar,
worse,
that seems to be the way,
exactly.
isn't it? Long dollar. That's that.
Yeah,
But I mean, I hear you in this one. The thing is that we're technically already in a recession, if the data is to be believed. But we have a weird case right now where there's very good employment. So until the jobs start to be shed, that's when it can really turn ugly. But the thing is that we're having this slowing growth, but yet we're at near enough full employment. So this is what's given the Fed the power to do what they're doing, because their whole mandate is that with unemployment rate below 4%, they feel the freedom to do these aggressive rate hikes. And until that changes and you start really seeing companies laying off people, but you go into the cities and you go everywhere. And I mean, it doesn't feel like we're in a recession. I mentioned this last time. There are families hurting, but they all seem to be employed. They're all getting paid and working 2 jobs maybe to make ends meet, to pay off their bills, but they're paying off their bills. So it's a weird case right now, because the stock market's obviously coming off with the rising yields, which is the general relationship you normally get. Stock markets tend to rise in times of easier policy. So when we actually look at the last 2 times we had a major dip, when it comes to 2009, 2008, the financial crisis, and also back in the beginning of 2000. But what was the one thing that led to the massive rebound in stocks is that the Fed going nuclear. Oh, and COVID, obviously, in 2020. We had the big bounce because the Fed basically dropped rates to virtually zero, untold amount of QE. The action by these central banks in 2008 and just recently was so aggressive that it led to this huge rally in stocks. But the problem we got in this case is the rates are doing a total opposite of what happened in the last 2 downturns. So the downturn, we had the catalyst, which was the ultra easy policy and the massive accommodation by the Fed and central banks around the world. We don't have that this time. So are we going to get this bounce? We don't have that huge injection of easy money. So I think this time it's going to be much harder to have that type of bounce that we were looking for in the last 2 downturns that we had. So I hope I'm the kiss of death, because I usually am, but I feel the most bearish I've felt in a long time. And then, and like you just said, where's the hedge? Crypto is a lousy hedge. In fact, crypto, to be honest with you, getting more despondent looking at crypto, because it feels like there's just really nothing. You always got these crypto guys that like, no, I'm at crypto, but I'll be honest with you, right? Ain't looking good. I mean, they're just as good as having it in a meme stock right now. They'll rally, but I don't know. Not liking any of the tape action here. I mean, definitely. So what? I mean, how you been playing this? That's the question.
I actually have been selling some of my winners. Like, I offloaded some decent sized positions I had in like Pfizer and a few others, just to make sure that I have enough cash on the sidelines. I did actually dip into margin, so I was just trying to get out of that. Yeah, I mean, to be honest, I'm pretty negative as well. The implied Fed funds rate, like the target, they're looking at 75 basis points, then 50, then 25, then 0, right? Over the next 4 FOMC meetings. I mean, if you look at the mortgage rates right now, meet Kevin, he put up this screenshot today. 30-year fixed is almost hovering at 7%. It's absolutely crazy. And we're looking at the highest UK mortgage rates since 2008. So it'll be really interesting to see what's happening in certain key real estate markets in the UK. It still seems like inventory is still low historically, so prices haven't kind of come down. It'll be really interesting to see in 6 months' time where the market's going to be.
I always actually think it's better to buy at this time, because I would rather get a house for a lower price than a higher price with a lower rate, because you can always refinance it during the term. And I mean, I'm just looking at some of the comments, and it goes, best place to buy when principal is low. You can always refinance in a few years. 300K at 7% is better than 500K loan at 3% in the long run. So I would rather get a better price house. And then, because remember, 7% ain't fixed. And it ain't going to be like that forever. It'll probably come back down to 5, maybe in a couple of years. You've got to take a bit of pain right at the beginning. But again, it's 2 ways of looking at it. Now is your chance to negotiate for a better deal, right? There's more sellers than buyers. The buyer is now in the ascendancy. Before it was the seller's market. Now it's a buyer's market. And if someone needs to offload property, It's all in the buyers. I reckon you can just get some fantastic deals. Knowing you've got to just take a bit of pain, but at the same time, you're getting it about maybe, based on $1 million house, hypothetically, you probably can get it 200,000, 250,000 cheaper than what you were paying a year and a half ago. So
this is where Rajan, buying $1 million vacation homes.
million Zimbabwean dollars. Yeah. But so I mean, this is, I actually think for a home buyer, I would be happier this way and really negotiate. I would never pay the asking price for anything. You've got these guys, we've seen it in some of these big markets in Phoenix, Texas. You're just getting continual, price declines. This seller has reduced the price. The seller has reduced the price. And it's your chance to get some good deals on real estate. So
but I just wonder if that's going to be the same in, say, New York City or in certain regions of California, or even in London here. Are you going to see drops, or is it just mainly where there's excess inventory? Where there has been a bit more of a bubble. But we're going to see all this stuff happening in real time. Just try to be in that mindset that when you look back at this time, you don't want to think, oh man, I should have bought here, or I should have done this here. These are the times that, all the people who are on the sidelines really, wish for. So now it's here, or it's coming, trying to make the most of it.
Yeah. I think this is like a record for the massive increase in the 30-year mortgage from literally a few months ago to what it's now. It's more or less doubled. And it's insane at the rate at which that mortgages, the rate of these mortgages have gone.
All this time, they just had the money printer on for way longer than expected. Like Professor Spiegel's very passionate rant, it's just basically saying like the pendulum, they were too far this way, and now they're going like too far this way. Like, it's the perfect analogy there. In my view, personally, I think that the Fed won't raise rates by more than 1.25%.
Yeah, I mean, if you look at the past rate meeting this week, the median dot plot, which is the forecast, went from 4 or something to 4.6. So what happened is that the dot plot increased by about 0.2 or 0.3%, which sort of derailed the market a bit. We had a lot of volatility on the back of that Fed decision. And but I do think they're trying to get to that level, that neutral level, or to that sort of terminal level. And once they get there, we're all hoping that they sort of stop there and they don't go into the five and a bit, but because they need to let this work and do its magic. The thing is that a lot of this inflation is embedded. And I've been telling this to everyone. Like, I mean, we had milk for a gallon, which was $3.50. Now it's $4.50. Now let's just say the price of milk, everything comes down. But are these guys going to drop it back to $3.50? It's just a new price. They know everyone pays $4.50, and that's what everyone's doing, right? We've got embedded wage inflation too. All of these pay rises for all of these, especially on the lower end of the scale, where like minimum wages now are like 15, 20. Bank teller gets 25, 20. That's embedded. Are they going to go back down to what they were doing? No. This is what it is. So some of this inflation is just now embedded because of the wage inflation. So that's just not going to change. But we can see a lot of these input prices have all gone down massively. Like the cost of a gallon of fuel is now much lower. I mean, lower than what it was. It was lower than prior to Russia. So that's all come down. We've seen gold, like everything's just coming down. But the thing is, the input costs are going down. But the biggest thing is rents and the embedded wage inflation. And the thing is, with mortgage rates where they are, what's the chances that rents are going to come down? That's the biggest component of inflation. And if that's what the Fed is looking at, these rate hikes ain't going to really do much to rents. Where you've seen New York City 5,000 average rent. It's just crazy. So I don't know how they can really turn the tide in that way. You've already seen Europe, the UK now doing this big stimulus in terms of capping the energy price. So that is going to help in terms of that aspect. But there's going to need to do a lot more to try to bring down inflation. But like I said, it's a tough thing to trade right now. I mean, I've said to you before that I was cutting a lot of my positions, trimming off the top. I bought all of that back. But I mean, how can you even defend against some of these stocks? Like Square went from 90 to 55, Nvidia 122. I mean, we're getting such destruction in some of these stocks that what do you even do? Like, do you sell it here? You just hold on for dear life.
Well, yeah, this is the thing. I mean, when we look at some of, especially growth stocks, how much they've already been battered down. And then, if we're looking at these kind of rates, I mean, it's like, where's the end for them, And you think about them trying to raise money in this type of environment, you're looking at, even EV startups like, say, Fisker, they look like they're going to go under.
Lucid is now $14, and they're now back below their SPAC price, because remember, they raised their from 10 to 15, so it's now trading $1 below their SPAC price, which is crazy considering at one point it was a $60 stock, $70 stock. So it's just a bit wild.
But we have to all see where the juggernauts, Apple, Microsoft, Amazon, Tesla.
I was mentioning this to you earlier. So you can clearly see in the portfolio that these the growth names have been destroyed. And now, if we're going to continue going down, they're going to come for your Apples, your Tesla. Like we've already seen Google's down 30% from the high, but Apple has held up really well, where they're only down about 18% from the high. So they'll be coming for them next. And as liquidation happens, the ones that are left in the strongest plays, that goes next. So I really hope I'm wrong, and I really hope we do get some bounces, because I feel like we have come down too fast, too quickly. But I don't know. It just feels like there's just so much catalyst, and I feel like the only thing that can really support this market right now is just attractive valuations. That's the only catalyst for some kind of bounce, because I don't see any other fundamental catalyst apart from just that looks cheap.
Ending the war. So what are the main options available for someone? I mean, obviously things might get even worse, so potentially you can kind of save any of the gains that you've got right now, just kind of crystallize those, hope that there's better buying opportunities lower down. But when's the bottom? How can you know? How long is a piece of string? You never know. I mean, Chamath in the All In podcast, he seems to have some really amazing timing in terms of his advice and what he thinks is going to actually happen. His prediction in November, when we were at kind of all-time highs, the richest and smartest people in the world are selling last year, and obviously he was thinking that you have to be really, really mindful. If you're not going to be doing it, how are you protecting your portfolio? And right now he's saying that he looks that there will be a bottom before the end of the year. So if you can hold out until the end of the year, potentially there's better days ahead. But
the question is, when you're holding out, how are you holding out? Like, is it going to just keep on drip feeding like it is right now, and then you're holding out for another 50% drop? It's very difficult. But let's look at the chart. So I'm looking at the S&P chart right here, the one that we look at all the time. And so this is, we had the June low, 36.36. That's the magic number, basically, right? And then since then, we had a nice rally, topped out just above 4,300, came off again. Then we rallied, we started to rally again. But this is that inflation print that we had last week, where inflation came in slightly hotter than expected, and we had this huge turnaround. We pretty much gave away the last week's gains in one session, and it was just gigantic. We went from like 41, 20 something back below 4,000 to 39.50. It was a huge drop, 4%, 5% in the market. I can't remember exactly the numbers on that day, but that was a huge red candle. And then since then we consolidated a bit, and then now we've accelerated again. This is just another huge drop. So we pretty much went from 4,150 odd all the way down to 3,700. So that's a 10% decline in literally 2 weeks. It's mad. And but I think the one positive thing is on Friday is we didn't quite reach that 36 June low. We got to about 36.47, so we're about 11 handles off the low in June, and then we sort of bounced a little bit. So if we can keep above this June low next week, hopefully then maybe there might be some type of avenue that we could sort of form a bottom and maybe just like hover around for a bit till we get to year end. But if we break, and we break convincingly, the next step we're looking at is around 3,500. That's the next sort of level that we're looking at, which is another pretty much 6%, 7%. So I hope that ain't the case. But I mean, look at these red candles, and more than that, this is the worrying thing, is that look at the volume increase on each bar down. So we had the highest volume on Friday on these E-mini contracts than we have had so far in this, I think, like pretty much in the last 3-4 months. Is the conviction to the downside was huge. Even like if you look at the massive volume down bar that we had on that day, that was pretty low. And then you look at what it was today, on Friday. So, if we look at the volume, it doesn't look good. But the thing is, sometimes as a contrarian, which I often am, which I am basically, this is what you got to do when everyone's fearful. This is when you got to just step in front if you've got any cash left, which I don't have much left. That's my problem right now. So
both of our problems.
But in terms of, for those tracking the average now I guess call it the money discourse portfolio. Remember, we were in the red. Now it's turned into the green. Went through a good patch, like calling a lot of trades correctly. But the thing is that now a lot of the positions I put on with, it just can't withstand this huge downturn that we're having. But the good thing is that I've got some time on my side, so hopefully we do have a little bit of bounce. But if we keep on going down, these positions all don't look good. They don't look good at all. But they're all capped in terms of their max loss, so that's the one savior. But we'll see. Like the thing is that Nvidia, like I mentioned before, has just moved down massively. Meta, Alibaba back below $80. Jeez, And then I don't know. We've seen it on Twitter. Have you seen it? Like there's all these rumors that Xi Jinping has been, there's been an overthrow from the Chinese government. The Chinese military. I don't know if this is true or not, but the way he's been running China with their COVID policy, shutting down everything. When someone like 50 cases in a city, they're shutting the city down. I think the army have taken over. But again, it's huge amount of rumors on the internet. I don't know how it is right now, but like Adobe, they bought that 20 billion acquisition, and we had a huge drop in Adobe, trading at around 283. Is the lowest it's been for in a huge amount of time. So some of these stocks, gosh, it's wild. There's got to be some good opportunity here, but it's a question is how much pain can you take? Square, that's another one. This position ain't looking good. 61 on the low side right now. It's 55. I'm gonna have to see if I can roll this position over, but yeah, it's not looking good. Not looking good.
Not looking good. But it really depends on how much the psyche of Wall Street has kind of accepted this in terms of what was the likely probability streams of the potential outcomes on rates. Obviously it had formed the consensus that we were going to kind of start slowing things down, but I really hope that it will just be a couple of months of pain to then kind of get to some kind of stability, rather than we're going to just go crazy to the moon or anything like that. I don't think that's going to be the case, but it really it helps to just be on companies that are going to have amazing cash flow and just retain earnings and are able to be in a position that they don't need to actually borrow, and obviously someone like Apple with their massive cash reserves are potentially a good place. But we're going to really see the effects on them for the man on the ground when we see the kind of iPhone 14 sales. And I think that's going to be really telling on, how the consumer is doing, or are they just, kind of brushing this whole thing off? What do you reckon?
Credit. No, everything's credit, Yeah. If stick it over a 3-year plan, it's cheap enough. And if they really want it, that's what we're going to get. But I think, like you said, we're going to see, we had second quarter, we've had loads of companies downgrading their guidance, saying, even pulling their guidance. But the real geniuses are going to be the ones that, what's happening, everything's falling in unison. That's what happens. Baskets are being sold, and so everything gets sold. It's about seeing the companies that actually can survive this sort of period and then thrive on the other side. And those are the ones that will outperform. Like when we actually look back in 2020 on the COVID crash, so many companies went parabolic after that. And just whether you can, some of these, it's gone to levels that it doesn't even make any sense. They're trading like at half times revenue, 10 times earnings, 8 times earnings. We're getting some of these valuations that we haven't seen in such a long time. And so I think we've still got about a month before third quarter earnings really starts. I think it starts like mid-October, and you're going to start off with, obviously you're going to get your Netflix, and then you'll get all your big tech names and everything comes out. So it'll be really interesting to see what all the management commentary is, and to see how much these rate hikes have really impacted their demand or not. And, going forward. So I think this next earnings cycle will be key. But till then, I've just been pretty much trying to look at some of these high flyers, just, trying to just step in front of them, playing it small. Key is play small, play often if you can, because, the one thing that will kill you in this market is over leverage. And we've seen with crypto, we've seen with everything, leverage is what's killing. And then you just don't know how long this is going to go for. And if you're too leveraged and then you're forced to liquidate, and it's just a cascading effect. So, it'll be interesting. I hope we get a rally a little bit until these positions expire, and then I can put on new positions. Then I'll be all right. But I've been short oil, I've been short nat gas, and that has helped a bit. But even that, I've now covered them. Like, how long am I going to hold it? But Now I sort of need that to bounce a little bit, if anything, so I can short it again. But yeah,
you need to sing that song, that God save the portfolio.
God save the portfolio.
Yeah. Well, we'll try to do a few of these shorter length episodes. Try to keep you up to date with what our thoughts are.
I mean, keep tracking the portfolio if you're just interested, just purely for educational purposes. I mean, it's like I was saying, this are the positions I got on now. Don't look great, but it all depends on how it ends up at the end of the year. But we'll see how it all goes. And like and subscribe if you liked what you heard. And we'll catch you on the next one.